Hey everybody, Preston Bryn here with our weekly roundup for our trader user group. This is for the trading week ending August 17, 2018. Before I jump in, it's been a really interesting week. We still got Turkey. It's got the markets on edge, although the contagion fear with Turkey is probably a lot less than what we had with the Asian crisis way back when. Um, I think Turkey, really the big issue with Turkey right now is the banks holding a lot of Turkish debt from Spain, Italy, and France. Outside of that, it seems to be fairly contained at this point. But you know how markets can escalate, and we can have fear seep into other areas. So we've got to keep a close eye on it. I mean, Turkey has really given it all up over the past 60 days here. But besides Turkey being on edge, we've got, we see what a combination of lack of sleep, stress, and Ambien will do because Musk has had his breakdown. For our members, we've had some really interesting and very profitable plays in the Tesla stock. And we've still got a trade going on even at this moment with Tesla, and I think it can still move pretty good bit. Um, so that's just been a really interesting play there. I think it doesn't really matter what I believe as far as what's going to happen to the guy, but clearly he's brilliant. You know, I think the best thing that can happen for Tesla is they bring in a new CEO to that really understands automobile production, and then they just keep him on as chairman emeritus so that he can just kind of stay there and do what he needs to do and keep his name on the front door. So that'll keep investors happy with the new CEO and bring in some more rigor to the production line while keeping Musk on, which will keep the fans very happy. And then I think that's probably the way it's probably going to work out. Meanwhile, we got trade wars. We've got positive things popping up with China. They're coming back into DC, so we could expect a Trump tweet in the next week or two saying that everything seems to be going good. We'll set up a meeting with Trump and President Xi, so we'll delay the tariffs for another through the midterm elections. Imagine that. So because Trump wants the markets to be higher going through, he doesn't want to go into the midterm elections in November with the markets just on fire to the downside. And I think the markets and price action kind of sees the same thing. So that's kind of what we've got going on there. Um, and we're realizing in all of these trade battles that, we do have a lot of influence globally. I mean, I was reading something in Barron's this weekend. 60% of the world's capitalization is held by about 18 major indexes across different countries. And the US represents the top three trader for exports for those countries. Uh, that is huge. However, the U.S., we're kind of an island to ourselves. I think the largest import um, for us is with China, but that's around 5% or so. Everybody else is under 3 or 2 or 1%. So the U.S. pretty much is an island when it comes to trading. Everybody wants to do business with the U.S. So Trump in this trade battle, he's from a timing perspective, he couldn't have done it at a better time. And that's what's bringing a lot of these people to the negotiating table. So we may see something happen with NAFTA, at least with the Mexican part. Canada may come along. I mean, they may be forced along. Europe seems to be playing ball a little bit. I think China's been the lone holdout, but I think they're going to be forced to the table because China's got issues. In addition to the Trump trade tariff issues, none of them of Trump's doing. I mean, they've got a big baby bust issue. They've got a problem with not enough workers to support an aging population there. I mean, they had this one child policy, which is typical of a communist party, communist nation, for over 35 years. They penalized and punished families that had more than one child. So that kind of got into the social fabric of folks over in China. So now, even though they've ended it and China's trying to talk their population into breeding more like rabbits, none of the women there and families want to do it. They're kind of like grew up on this one child thing. So they're going to have a huge problem with this aging population. Keep in mind, that's the same thing that happened with Japan, which put Japan in a 20-year funk, a deflationary funk. So they've got that issue going on, and they've got this bank bust issue here where their loan growth is just catapulted. So now China's got to manage this balancing act between too much debt, because they got like 270% of their GDP is debt, while managing this reduction in trade issues and fiscal policy stimulation. So they've got a lot of issues instead of trade tariffs. So there's going to be some issues there popping up that I think are going to be very interesting. So you put all of that in the blender here, and just about all the money is coming into the U.S. markets, hence a very strong U.S. dollar against all other currencies. And you can just kind of see now, if we look at the screen here, I've got the S&P E-mini futures on here. It's a daily chart, and you can see we're moving up. We're only just a percentage point or so away from our all-time highs at 28.7850. You can see back in February, we pulled back to about a 12% drawdown. And even that did not get us. Let me just bounce out just a little bit. I'm going to show you. If you look at this yellow line here, that is the 200 EMA. We haven't really, and this is a daily chart. So if you look at it, we haven't been below the 200 EMA more than a couple of days in a row, going all the way back to 2016. And then back in the beginning of end of 2015, going into 2016, we haven't been below the 200 EMA in quite some time. So the markets have been very strong. And you can see I've got on the screen the pre-Brexit vote, the overnight Trump election lows here, which were made at 28.50, and then the post-Brexit vote. And then how we've just been on a tear since then. I mean, it's just been very strong. And then, of course, if we zoom in, you can see this upslope and trend line here. So I'm kind of using this as a bogey. You can also see our volume over price. We've got a huge support area around 27.25. And then we've got one just slightly below our 2018 open price. You can see the upward vector on the 200 EMA is tracking our trend line perfectly. So that's going to be, to me, a go, no-go line as far as, where are we in this? And even with its huge pullback in late January, early February timeframe of over 12%, we didn't go into a bear market. It was just more of a correction. That's all it was. In fact, with our members, I had us getting long right in this area here, right around April, May timeframe. Okay. This was just day trade work here. These were typical bounces running all the way up to almost 2,800. And then we came all the way back down, literally almost to the February lows. And then once buyers came in and once we just tested it again, then we've just been off to the races. So that is kind of, we've been on the right side of the market. We were caught a little bit in January, but it was just over exuberance because you can see this huge fast move up without any divergences at all. And then once we got that pop and then a rollover, it just everything came unglued in a very short period of time, in just 2 days, 2 or 3 days, and it was over. And that was it. So we're still looking, in my mind, and as I said, we're in a buy the dip, okay? And we're in that buy the dip moment here. So I do think momentum will kind of carry us higher. We've still got a large preponderance of investors that are on the sidelines. So, as long as people are holding more cash, then that means there's more cash to come in from a bullish perspective. All right. There's still money on the sidelines waiting to be deployed. So I do see near term is up. Now, I will tell you guys that if we do take out 28.7850, which, I've been saying all along we're going to do that. Even while we were down here, I said we're coming back up again. We've got just very strong fundamentals in the U.S. But I think once we take out 28.7850, we may have a very fast run up. We'll get some more cash off the sidelines coming into the market, and then we'll have a nice little pullback. And then during that pullback, we're going to be able to determine, what next over the next 6 months. Near term, I am a buy the dip trader, and that's kind of the way I'm going to continue to take a look at it. The other thing is, as I said, we've just had money coming into the U.S. dollar. I mean, if I come down and if we look at currencies right here, and we look at some of these currencies, you can see with the dollar right here, just very strong, right? I mean, the dollar has just made these new highs right here just a few days ago. the 15th actually, and now it's pulling back just a little bit. We've hit a Elliott wave 5, so this suggests an ABC pattern. So we're going to get into chop here with the dollar, but you can see it hasn't. The 50 EMA has held it up, but we're so far north of the 50 EMA that I think a little bit of a pullback, probably to the 95 area on this dollar index. And then that would also suggest that the euro is going to give us a little bit of a bounce. We came down and hit my target in the euro. In fact, we went slightly below the target of 114. And now we've got this Elliott wave 5 here. So that again suggests an ABC chop, maybe a little bit higher, but I do believe the euro can go a little bit lower. Super Mario Draghi's on record is saying they're going to keep interest rates, intrabank lending, negative rates, and their consumer rates 0%. So, and they're still doing the tune of 30 billion a month, roughly, of euro stimulus. So, I just don't, the dollar is going to stay strong near term. All right. That's going to continue to push money into the U.S. market. It's going to continue to push our equities higher and our interest rates lower. Because if we look at our interest rates on the treasuries, look at the 10-year interest rates. You can see here, I mean, we're well off the highs. I mean, everybody thought once we break 3%, we're going to just keep right on going. You can see the initial break at the 3%. It ran up really quick, and then there was a quick sell-off. A lot of shorts came in, because the markets do not believe strength in the economy a year and a half from now. They still also do not believe inflation is going to be too much of an issue for the Feds, even though inflation has moved up, since 2011. Inflation has moved up a pretty good little bit. In fact, we had the highest level of inflation we've had since 2011 over the past couple of weeks in the reports, but not enough to really get interest rates that much higher. One of the reasons is we got so much money coming in from offshore to buy our bonds and our notes and our T-bills. They get a lot more yield. Heck, they can get a 2% yield on a T-bill in the U.S. versus 30 or 40 basis points on a 10-year. So, I mean, why wouldn't the money come here? And that keeps our interest rates lower. You can look at the bond market. Bond market has, attempted a little bit of a climb here, but as I've said, anytime we get in this shaded zone here, I'm more a seller of bonds than a buyer. Short term, I think bonds can move up a little bit, but longer term, I think bonds are going to come back down again. That's kind of where I'm looking at for the treasury market. And volatility, well, we took some trades involved. With our members this Sunday, I'm going to go through some ways that we're trading vol that give us about an 85 to a 90% probability of success. Right? I mean, that's high. Most people that trade volatility do it wrong. They really do it wrong. They do what most rat brain traders do. They get on the same side of the boat, and they just don't understand how volatility works, let alone the VIX. Most people don't even understand when they're trading options in the VIX what they're really doing. This Sunday, I'll go into a little bit more detail, and then our option masters, I'll go into excruciating detail on how to trade volatility. I think you guys will really like it. Just that one strategy alone will, cover the cost of your membership in our group, our user group, which if you're not a member, I highly encourage you to come in. Anyway, so we're looking at volatility. If I come in and I take a look at the VIX here, you can see that we're, at the upper edge of the green zone or the green band of all. So generally when we're in the green band, our option strategies, we look for different kinds of option strategies. We kind of danced a little bit in the yellow zone, but we quickly came back down again. All right, so I just do not see vol spiking here. The only thing that can create a lot of the spike in vol near term is going to be any kind of Trump tweet regarding tariffs, or possibly Turkey. But even Turkey was not enough once the markets figured out that the contagion effect has been minimized. Now, Turkey can always increase the contagion. I mean, they can always do some other crazy stuff and cause banks across Europe to catch fire. But I don't see that happening right now. That's kind of what I'm looking at with volatility and currencies. And of course, if we come over and we look at metals, metals, gold, what can I say about this? Gold has, and let me just mark the chart up. We had a 2018 low here with gold. at 1167. Now, once we broke gold, and this is from this 2018 high, if I were to just kind of bring it down to the 2018 low, right? Let's just put it down here just to give you guys a pullback per spin here. And let me just edit that. And it would go down to 1167.10. So let's just change that to 67.10 like that, right? Just get that over here. So we got 1167.10. So gold is off this year or hit a low of 14.77%. So not a bear market. You can see all of these resistance areas up here. It's the 2016 high, 2017 high, and 2018 high. So that would probably, a reasonable man would logically assume that we've got huge resistance here going back a long ways. I believe we're going to break through these levels. Not now, but in the next couple of years. And there's going to be some great trades to make in the gold and silver market from a macro perspective. Near term, I've been on the bandwagon saying gold is going to go lower. In fact, I've been on the bandwagon saying gold could come down to the 1100, 1130 area, somewhere down in this area here. Any rally here in gold appears to me right now that's still going to be sold off unless the charts change or shows me something different. That's kind of what I'm going to look at in gold. Obviously, silver is the same way. You can see silver futures just really, once it broke these, we had a couple of symmetrical triangles on here. The break, the forecasted break was to the downside, and away it went. All right. And we've entered some trades in SLV, again, a macro trade for our members. We got a real interesting option trade in that combined with stock that I think our members, it's a really interesting play. I'll go through it with you guys this Sunday evening for our weekly market watch for next week. So that's the precious metals. If we look at copper, which is a construction, more industrial metal, it has given it all up, just like China. Look at this. I mean, it's just fallen off the table. And this, because China is the largest buyer of copper, then you can see here just the dramatic move in a very short period of time. This was early June. Copper futures is all the way down here. I think it's going to, a little bit of a dead cat bounce kind of thing here. And this is going to go where China goes, guys. So if China, and we solve the trade tariff issue, you're going to see copper come up and challenge this pivot high up here around 287 and possibly higher. Okay. That's going to be what we're going to see there with copper. Now, if we look at energy and oil, oil is doing what I've also had indicated to our members. I said the near term for oil is more likely down than up. You can see once we broke this trend line here, this trend line, by the way, goes all the way back to the summer of 2017. And we've had a chance at breaking it here. We were held up by a key pivot. You can see we broke it here. We come back down to this key pivot. So this 64.24 seems to be a very key pivot. So we've had another test of that pivot right here. And now we're getting a little bit of a bounce. So I'm going to look to see if we don't set up a head and shoulders pattern and then bring oil back down into the high to mid 50s. All right. Right now, though, we've broken the 50 EMA. The 200 EMA, or the 50 EMA's got a downward vector to it. The 200 EMA is starting to flatten as I blow this up for you guys to see. You can see in this area here, we're sandwiched between the 50 EMA, which is 68.36, and the 200 EMA, which is 63. So we're going to trade in this range for a bit. I don't see too much upside. I don't see too much downside, but I have been saying near term neutral to bearish with oil. I was saying oil would come down to the 62 to 63 area, basically in this zone around the 200 EMA, which is at 63.77. That's kind of what I've been looking at. And if we look at Brent oil, and we want to pay attention to Brent because this is going to be affected by the Iranian oil tariffs. They're going to go into effect in November. And you can see this trend line here. We finally, Brent was able to hold it, and then it broke it. And then we broke this key pivot right here. And now we're back up above. So we're barely holding on right here. Not quite a head and shoulders kind of pattern, but we've tested this 71.26 area several times. You can see the MACD showing these divergences here. We're closer to the 200 EMA, so Brent's been given up. You can see the volume over price. We've got the next area of support for us is going to be right around the 68.80 area. Now, all of this is going to take a toll on the spread between Brent and WTI crude. And you can see here, here's the spread. Now, when the spread got very wide, we were selling the spread up here. We were basically shorting Brent and going long WTI. Okay, and you can do it on the Thinkorswim platform. And it's $1,000 a point. So we had some members that traded it all the way down, did very well. Some of us got out a little bit earlier. The 5-year average of this spread is around $5. And you can see the 200 EMA and the 50 EMA are like railroad tracks. And that's the average. This spread is going to change in November, going into November. The odds favor this spread to come back in. Okay, and for Brent to go down, WTI relative to Brent to go up. So that would suggest that we're going to come back down and the spread is going to narrow again, meaning WTI is going to get closer to the cost of Brent. So we're going to watch this very closely. Could set up for some really interesting things. Meanwhile, agriculture, we got some interesting things going on in ag. We got some trades in ag. There's a new trade set up in agriculture that we're going to be talking about. But if we come back and just take a look at a couple of quick things, let's look at China. In the emerging markets, if we look at China, you can see here that on this daily chart, and let me just move it down to where China actually did go to, right? I mean, China actually came down here. And if I were to, let me just edit this and put 2368 on here so that you guys can get the accurate reflection of just how far down China has. This bear market in China took us down to 32% down. We're now sitting right here, just slightly above that. But you can see the 2018 open price. But this 32% drawdown is off of the January highs, like all other indexes. We've got some massive divergences on here. So this would suggest, I believe, if you believe that Trump is going to play the financial markets like an insider, and he's going to probably figure out a way to either postpone or solve this China trade tariff issue, and you're going to see Asher and the Chinese Shanghai index move up big time. I mean, big time. That means you're going to get you're going to see the euro get stronger, the dollar get a little bit weaker relative. You're going to see copper get very strong. You're going to see emerging markets get stronger. Most commodities are going to be a lot stronger, including oil near term going into the election. So near term, that's kind of what I'm thinking and looking at. And also, if we look at the all world index with Vanguard, we were down Wednesday of this week when Turkey really came to the forefront. We were down a pretty good bit off of our 2018 highs, right? And let me just kind of just give you an idea what that one looks like. If we look at this and bring it down, that is roughly, and let me just edit it to get an exact number on there, 50.25, right? So let's just reduce it by a couple of points. So the Vanguard All World Index was down 14.7%. You can see the 2018 open price. We're still way underwater. But the rest of the planet's not doing very well. That's why all the money's coming into the U.S. and buying bonds in the dollar. That's what's going on right now. And if we look at emerging markets, folks, it's the same thing. If we look at the emerging market ETF, you can see here we're down 21%. We actually, in the emerging markets, briefly this past week moved into a bear market. We moved back out of the bear market on Friday's close. But I mean, we're very close. But we got divergences, positive divergences in all of these emerging markets in China and looking at all of these. So this would give me hope that we could see these things start to stabilize towards the bottom. All right, so we got to watch these very closely. And then finally, to round everything out, if we look at the transports here in the U.S., I like to look at the transports. You can see here the transports have they're in the process of breaking out again. That would suggest that we can make new 2018 highs in transports. And if we look at the Dow, you can see the Dow is taking out a prior pivot right here. It's going to challenge the prior pivot high in February. Again, the Dow on a relative basis is going to outperform them all if they solve this or postpone or solve the China trade tariff issue. So doing that would be a very strong thing to do. And you can see with the 200 EMA with the Dow, even with the Dow, as ugly as it is, if we look at the 200 EMA, look at this. We haven't penetrated the 200 EMA with the Dow until going back to 2016. Right here, you can see right in this area here at the beginning of 2016. Yeah, we were below it for a day, maybe 2 days, but that's not enough to really get the escape velocity to go lower. So really in January of 2016, January and February 2016, outside of that, so that's why we got to watch the 200 EMA as a longer term support mechanism for not only the Dow, but all the other indexes as well. It's kind of held up fairly strong for us. So as long as we're north of the 200 EMA, then and north of the 50 EMA, then I've got a buy the dip mentality. If we go south of the 50 EMA, but stay north of the 200, then we're in a neutral to slightly bearish chop. And then I'm going to wait to see which way the markets go. All right, everybody, that's kind of where we're sitting right now. Hope you're having a good weekend. Members, I will see you this Sunday evening for our weekly market watch for our option masters. That's next Thursday. We've just having a ton of fun with that thing. If you're not in it, I highly encourage you to come in. We're covering a lot of stuff. Otherwise, have a great weekend. See you guys later. Ciao, folks.